presented by Rezi. Bite-sized job search tactics for the AI era. Whether you're rewriting your resume, prepping for interviews, or figuring out your next move, we're here to help you compete smarter. Let's land it.
Today we're looking at a stack of reports that paint a very specific and frankly a very confusing picture of the world right now.
Yeah, it's a lot to unpack.
It really is. Because it is February 2026, and if you are just glancing at the headlines right now, you might think the economy is broken, or at least that the calculator is broken.
It definitely feels like the math isn't mathing, as they used to say.
Right, because look at the contradiction we're seeing in these sources. On one side of the ledger, you have the tech giants. Amazon, Meta, Microsoft, Google.
Hyperscalers.
Exactly. And they are posting absolute record revenues. They aren't just doing well, they're printing money. And they're spending capital like it's going out of style, specifically on AI infrastructure.
Oh, yeah, we're talking about hundreds of billions of dollars in capital expenditures.
But then, you look at the other side of the ledger, mass layoffs are at their highest level since the chaos of the 2020 pandemic.
Staggering.
Over 1 million jobs gone in the last 12 months. So the mission for our deep dive today, the question we really have to answer, isn't just what is happening, but why. Why are the richest companies in history firing everyone at the exact moment they're making the most money?
It's the paradox of the moment. And to really understand it, we have to look at a concept that emerged from the data in our source material. It's being called the pivot penalty.
The pivot penalty. It sounds like a sports term. But I gather the players here are CEOs, and the penalty is being paid by the employees.
That is a very fair assessment. The pivot penalty basically describes this brutal new rule of corporate finance that has taken hold in 2026.
Okay.
The rule is simple. The more a CEO mentions AI or generative on an earnings call, the faster they slash their payroll.
Wait, is that just anecdotal, or is there a genuine correlation there? Because it feels like every CEO is talking about AI constantly.
No, it's hard math. We have an analysis in the reports of the Q4 2025 earnings calls that just wrapped up.
Yeah.
And they found a mechanical pattern. Yeah. Companies that mentioned AI more than 10 times during their call cut their staff by an average of 15% in the following quarter.
15%?
That is massive.
It is double the rate of companies that took a more measured tone. So the hype isn't saving jobs. The hype is actually accelerating the cuts.
See, usually we think of layoffs as a sign of failure. Like, we're out of cash, sales are down, we have to cut back to survive.
Like the traditional distress signal.
Yeah, but this feels entirely different. These companies aren't distressed at all. This feels like a trade.
That is the perfect way to frame it. It is a trade. We aren't in a recession, despite what the job market feels like for white-collar workers right now. We are in a structural reset.
A structural reset?
Yes. We're watching a deliberate liquidation of human payrolls to fund the massive compute power required for this intelligence revolution.
Let's dig into that financial mechanic, because I think that's where the real story is for anyone trying to navigate this. You called it a liquidation. In accounting terms, this is basically a swap between OpEx and CapEx, isn't it? Precisely. And this distinction is so critical if you want to understand 2026. So OpEx, or operating expenses, is your day-to-day stuff. Rent, electricity, and most importantly, salaries.
The human costs.
Exactly. CapEx, on the other hand, capital expenditure, is money you invest in assets you own. Servers, data centers, custom silicon chips.
So in the old days, say 5 years ago, software companies were really heavy on OpEx. Because there's just people writing code.
Right. They were light on CapEx. They just rented cloud space.
Yeah.
But AI completely flips that model. AI is incredibly CapEx heavy. It requires billions in physical, tangible infrastructure.
Or power plants, basically.
Yeah, literally, in some cases. So investors and CFOs are looking at the balance sheet and saying, okay, we need to buy $100 billion worth of chips. Where do we find the cash?
And they can't borrow it all because interest rates are still biting.
Exactly. Interest rates are a major factor. So they find the cash by slashing OpEx. They are firing the people, the OpEx, to buy the machines, the CapEx.
That definitely explains the aggression. But I want to push on the timing here. Why now? Why is 2026 the breaking point for this swap? We've been talking about AI for years.
That comes down to a major shift in investor sentiment. If you recall, back in 2024 and early 2025, we were in what the reports call phase 1.
The hype phase.
The hype phase, yes.
Right.
AI was basically a cheat code for stock valuation. You mentioned a chatbot, your stock goes up. It didn't matter if it actually made money.
Right. It was all about potential, growth at all costs.
But now, in 2026, we've entered phase 2. The market has moved from rewarding hype to demanding math. Investors are saying, okay, you promised us a revolution, you're spending billions, show us the durable cash flow.
A bill has come due.
Exactly. They need to prove that these massive infrastructure projects are actually sustainable. And to protect their profit margins while spending all this money, they have to cut costs somewhere else.
And somewhere else is human beings.
It is. The workforce is bearing the brunt of it. I mean, look at the numbers. We saw 1.2 million layoffs in 2025. And just in January of this year, January 2026 alone, there were over 108,000 layoffs. That is triple the volume of December 2025. The tech sector alone has shed nearly 480,000 jobs since early 2024.
Those numbers are just chillin', so let's follow the money. Where is that CapEx actually going? We threw around the term hyperscalers earlier. Amazon, Microsoft, Google, Meta. The sources say their combined spending is projected to hit $600 billion in 2026.
$600 billion. It's a number so big it almost loses meaning when you say it out loud.
It really does.
But to put it in perspective, that is a 36% increase from last year. And 75% of that massive pie is tied directly to AI infrastructure.
Amazon is the case study that really stood out to me in these reports. Because their timeline is so compressed, they've been cutting aggressively 30,000 corporate roles in a 120-day window, spanning late 2025 into early 2026.
It's a very fast, very sharp cut.
But at the same time, they're planning a $200 billion CapEx investment for 2026. And a lot of that is going into something called Project Rainier.
Yes, Project Rainier is fascinating.
They're building 500,000 of their own custom Trainium chips. But why go through the hassle of building your own chips? Designing hardware is incredibly hard. Why not just buy them from Nvidia like everyone else did in Phase 1?
Well, this is the strategic insight that often gets missed in the headline panel. This isn't just about buying chips. This is about breaking the Nvidia tax.
The Nvidia tax.
Yeah. For the last few years, Nvidia has had a total stranglehold on the market. Their margins are astronomical. So if you are Amazon or Google, every time you buy a GPU, you are handing a huge chunk of your potential profit directly over to Nvidia.
Oh, I see.
You're completely dependent on their supply chain and their pricing power.
So Project Rainier is basically Amazon's escape plan.
It's a declaration of independence.
Right.
By building their own Trainium chips, Amazon is trying to control their own destiny and dramatically lower the long-term cost to compute.
But that requires a massive upfront investment.
Exactly. You have to design the silicon, build the fabrication plants, test the hardware. It is incredibly expensive today to be cheap tomorrow.
And to pay for that incredibly expensive today,
You cut the 30,000 corporate roles. You sacrifice a portion of the current human workforce to secure the future physical infrastructure.
and the wild thing is, the market rewarded them for it. Their stock price rose on the news of those layoffs. Wall Street analysts were literally cheering the structural reset.
They love it.
Yeah.
Because from a pure spreadsheet perspective, it looks brilliant.
Yeah.
You are trading variable, messy human costs for fixed, scalable asset costs.
Right.
But if you go to the retail trading forums or just talk to normal people, the sentiment is very different. People are extremely bearish because they are seeing the human cost up close.
It's not just Amazon either. Meta's doing the exact same thing. They've pivoted hard from the metaverse to what they're calling Meta Superintelligence Labs, which honestly sounds like the villain's lair in a James Bond movie.
It does have a certain sci-fi ring to it.
Yeah.
But look at the internal shifts there. They are cutting Reality Lab staff, the VR folks, about 1,500 cuts there. And they're using that to fund this superintelligence push.
The reports also mention Meta claiming their AI coding tools have boosted engineer output by 30 to 80%.
Yes, that's a key metric they're pushing.
That stat is fascinating, but also really alarming if you think about it. If your engineers are 80% faster, a company doesn't necessarily just decide to produce 80% more products. They might just decide they need fewer engineers to do the exact same amount of work.
That is exactly the bet they are making. They are using that AI-driven efficiency to justify a smaller, denser workforce while they pour $115 to $135 billion into the spending side.
This brings us to a concept in the deep dive that I found incredibly cynical. It's called AI washing. Now, we know greenwashing, right? Pretending your company is eco-friendly. But AI washing seems darker. It's not just marketing. It's being used as a literal cover story for HR decisions.
It's a highly deceptive practice. AI washing in this context is when a company announces layoffs and blames it on AI efficiency, or pivot to AI when the real reasons are incredibly mundane.
Mundane, like,
Like they just overhired during the pandemic. Or they have too much debt and interest rates are high. Or maybe they are worried about new trade tariffs squeezing their margins.
but AI just sounds so much better to the shareholder.
Oh, much better. Think about it from a PR perspective. If a CEO stands up and says, we messed up, we hired too many people, our strategy failed, so we have to fire them, the stock drops. It signals incompetence.
Yes, nobody wants to admit they failed.
Right. But if that same CEO says, we are proactively resizing our workforce to unlock the transformative power of agentic AI, the stock goes up, it signals innovation and forward thinking, it frames a total failure of headcount management as a strategic victory.
Wow. So for the employee who gets fired, this creates what the report calls a fog of uncertainty. If you get let go, you don't even know if you were actually replaced by a robot, or if your boss just needed to balance the books and used a robot as a convenient excuse.
That is the reality for thousands of people. And the data bears this out entirely. In 2025, AI was cited as the official reason for about 55,000 layoffs. But when researchers looked closer at those specific companies, many of them didn't even have the mature technology ready to replace those roles.
So they were just fronting.
Exactly. They just wanted the narrative. They wanted the pivot penalty to work in their favor.
While we're talking about narratives versus reality, we have to look at the software industry specifically. We've talked mostly about the hardware giants, the hyperscalers, but the deep dive outlines something called the SaaS apocalypse.
Yes, the SaaS crisis.
And it is hitting the software companies just as hard. This seems like a fundamental business model problem, not just an HR problem.
It is an existential crisis for the software as a service world. Think about how software has been sold for the last 20 years. The per-seat model.
Right. Like, I run a company, I hire 100 salespeople, I have to buy 100 Salesforce licenses, one for every human.
Simple, incredibly predictable recurring revenue. It made the SaaS industry rich. But now, enter agentic AI.
And just to clarify, these aren't just chatbots answering questions.
No, these are agents capable of independent reasoning and action. If I have an agentic AI that can scour LinkedIn, draft targeted emails, update the CRM, and schedule follow-ups, and that one single agent does the work of 5 junior salespeople.
Then you fire the 5 salespeople.
Yes. But crucially for the software company, the enterprise stops buying those 5 Salesforce licenses. You only need 1 license or 1 API key for the agent.
So the software company's revenue collapses. The more efficient their AI product becomes, the less money they actually make from human licenses. That sounds like a complete death spiral.
It is a death spiral unless they change the model entirely.
Yeah.
And that is exactly what we are seeing happen right now with companies like Salesforce.
The report highlights Salesforce CEO Mark Benioff specifically on this.
Yes, Benioff is pushing a massive shift to what he calls the agentic enterprise. They're rapidly moving away from selling seats, and they're starting to sell outcomes. Or they offer fixed price, unlimited access to the AI.
But in that transition to selling outcomes, the human workers are the collateral damage. The deep dive mentions Salesforce cutting their own customer support staff from 9,000 down to 5,000.
Almost half.
Yeah, because their AI agents now handle 50% of the help site conversations.
They are eating their own dog food, as the tech industry says, and it's actively costing jobs. But I want to connect this software shift to the broader human impact, because this is where we get into the broken ladder problem.
This was the part of the research that frankly terrified me the most. We always assume AI comes for the routine, boring jobs, but routine jobs are also training jobs.
Exactly. Think about how you learned to do your job. You probably started at the bottom doing the grunt work. Data entry, basic research, drafting simple memos.
Right, the apprenticeship model. You do the boring stuff to figure out how the machine works, how the industry operates.
But if an AI agent could do all that boring stuff instantly and almost for free, companies just stop hiring juniors entirely. And the data shows this is already happening. Jobs requiring less than 3 years of experience have dropped by 15% in software development alone.
So the very first rung of the corporate ladder is just gone.
It is evaporating. And this creates a massive, massive long-term problem. IBM has predicted a future crisis where we have an economy with no senior experts because nobody was trained in the 2020s.
Wow.
If you don't hire junior talent today, you literally do not have senior talent in 2035.
It's so ironic, isn't it? We have Gen Z entering the workforce right now, and the reports note they have the highest AI quotient. Something like 22% of them are considered highly proficient with these tools. They know how to use them better than anyone. But they face high unemployment because the training ground jobs they need to get a foot in the door have been automated away.
It's a tragic inefficiency. We are locking out the very generation best equipped to navigate this new future.
Now, I want to pivot to the hidden side of this automation. We talk about AI like it's magic, like the computer just thinks. But the deep dive highlights this massive ghost worker economy. The reality that a lot of what we call AI is actually just people hiding behind a digital curtain.
This is the dirty secret of the whole AI boom. Some economists are calling it photomation, fake automation.
The most famous example recently was Amazon's just walkout technology.
Right.
These were the grocery stores where you just grab a sandwich and leave. Right. I always thought that was incredibly advanced computer vision and sensors.
It was certainly marketed as advanced computer vision, but subsequent reports revealed that the system relied heavily on about 1,000 human workers located in India.
1,000 workers.
Yes, who were literally watching video feeds of shoppers and manually labeling what you took off the shelf so you could be billed.
So it wasn't a supercomputer at all. It was
Yeah.
just 1,000 people on a video feed watching me buy milk.
Essentially, yes. And this dynamic is happening everywhere behind the scenes of generative AI. There is a massive invisible workforce, often located in the global south or in low-wage areas of the U.S., and they act as the first line of defense for AI.
What do they actually do all day?
They are labeling data, they're fixing AI hallucinations manually, they are categorizing toxic content. Sometimes they're even stepping in to answer chat queries in real time when the bot gets confused and fails.
And I'm guessing these are not high-paying, glamorous tech jobs.
Far from it. This is the Uberization of white-collar work. You have
Right.
data workers in the U.S. earning maybe $15 an hour. They sit at their computers, often unpaid, while they wait for a task to pop up on their screen. It is literal digital piecework.
It seems like a massive security risk, too. If you have underpaid, overworked gig workers handling sensitive enterprise data just to train these language models.
It is a huge risk, and it dramatically affects quality. Think about it. If you are paying someone pennies per completed task, they aren't going to spend time thinking deeply about the nuance of a complex answer. They're going to click the button as fast as possible and move on to the next penny.
Right.
So we are building these trillion-dollar, supposedly super intelligent models on the backs of precarious, rushed, underpaid labor.
So the pivot penalty isn't just erasing jobs, it's downgrading them. It's taking a $60,000 a year junior analyst job with benefits, destroying it, and turning it into three $15,000 a year gig tasks without benefits.
That is the net result for a very large swath of the economy. It is a massive labor arbitrage play.
But here is the paradox in the data that I really want to get your thoughts on. At the exact same time companies are firing these generalists and relying on these ghost workers, they are frantically hiring for very specific roles.
Yes, the hiring boom paradox. If you look at the tech job boards right now, 50% of postings require some form of advanced AI skills, and they're paying a massive premium for them.
Like 15 to 25% salary premiums, right?
Yes, for prompt designers, AI ethics officers, complex model architects.
So if you are in that top 1% of specialized talent, life is incredibly good.
Life is very good for them.
Yeah.
But there is a huge twist coming for the companies doing the firing right now. The expert analysis in our source material calls it the layoff boomerang.
The boomerang, which implies what exactly? That they're going to have to hire the people back.
Exactly. Forrester Research is currently predicting that up to 50% of these AI-driven layoffs will be quietly reversed in the next year or two.
Because they fired everyone too soon.
Precisely. They cut the human staff to appease Wall Street before the AI was actually capable of handling the messy complexity of the real world. They fire the customer service team, and 6 months later they realize, oh wait, the agentic AI can't actually de-escalate a furious enterprise client. We need a human.
So the employees just get their jobs back.
Well, not exactly, and this is the most cynical part of the entire structural reset. They might hire for that specific role again, because they need the work done, but they won't hire the same person back at the same salary.
Oh.
They will likely rehire that role offshore or as a contractor or simply at a much lower wage tier.
I see. So the layoff deliberately breaks the salary history. You fire the expensive legacy employee who got raises every year. You wait 6 months. You realize you still need the work done. And you hire someone new, but much cheaper.
Correct. The pivot penalty acts as a broad mechanism to reset labor costs downward across the entire industry. It uses the technological disruption of AI to break the wage stagnation and the worker leverage that employees had actually benefited from during the talent wars of the early 2020s.
That is a deeply sobering realization. It really reframes this whole moment for me. It's not just about technology advancement. It's almost entirely about financial engineering.
It is both. The technology is undeniably real and powerful, but the deployment of it, the timing of it, is driven completely by the balance sheet. We are moving from an era of growth at all costs, where having a massive headcount was actually a vanity metric for CEOs, to an era of efficiency at all costs.
So if we step back and look at the big picture for our listeners, we have the SWOC of human payrolls for silicon chips. We have the SysPocalypse fundamentally changing business models. We have a broken career ladder for juniors. What is the ultimate takeaway here? If you were listening to this right now, how do you navigate 2026?
I think the core takeaway is that the companies that truly win in the long run won't be the ones just shouting AI on earnings calls to fire people. That's a short-term stock play. The real winners will be the organizations that figure out symbiosis.
Symbiosis, meaning figuring out how to actually integrate the AI with the humans you keep.
Right. Not replacing the human, but radically amplifying them. But for the individual listening, the reality is harsh. The average generalist worker is in the danger zone. The safety lies in being either the highly specialized expert who builds the AI or the expert who possesses the soft skills the AI cannot replicate yet. High-level strategic thinking, complex human empathy, navigating ambiguity.
And knowing how to read the room, like seeing through the AI washing.
Exactly. Yeah. Knowing how to check the math. Don't believe the corporate press release about proactive innovation. Look at the CapEx. Look at where the billions of dollars are actually flowing. That tells you what the company really values.
I want to leave everyone with a final thought that connects back to that broken ladder concept we discussed. Because the more I think about it, I think that is the sleeper risk of this entire decade.
You mean the long-term brain drain?
Exactly. If the entry-level role is completely dead, if we automate the junior analyst, the junior coder, the junior marketer, and we relentlessly squeeze out all the mid-level managers for efficiency, how does the next generation of experts actually learn anything?
It's a profound question. We treat human intelligence right now like it's a natural resource we can just mine from the ground indefinitely. But human intelligence, real expertise, has to be cultivated over decades.
Right. It takes time and failure to learn. Are we actively burning the bridge of human capital just to fuel the engine of artificial intelligence? And if we are, what happens 10 years from now when the AI eventually hallucinates or a system breaks and there is literally no human left in the building who understands the underlying system well enough to fix it, simply because nobody has been trained for a decade?
We might be optimizing our way into total incompetence. It is a very real, very frightening possibility.
On that uplifting note, we will leave you to ponder the future of your own skill stack. This has been the deep dive into the pivot penalty. It is a wild world out there in 2026. Stay curious and stay skeptical.
And always check the math.
We'll see you next time.